In the midst of a faltering economy, the prospect of an impending recession looms like an ominous shadow. While the Federal Reserve is poised to increase rates, a renowned expert, Sherman, predicts that policymakers will be slow to act, leading to the most significant cut since the pandemic's onset. Economic indicators are raising alarm bells, pushing Sherman to seek refuge in long-term government bonds. The bond market's signals are unmistakable, urging the Fed to cut rates. But the question remains, will they act in time, or will their delay worsen the inevitable downturn? As we stand on the brink of uncertainty, will the economy be saved from the precipice, or is a recession inevitable? Welcome to Global Economic Drops, where we bring you simple summaries of important daily and weekly economic news from around the world. Our mission is to simplify the economy and help you navigate the treacherous waters facing investors today. So before we get into today's videos, hit that subscribe button and turn on post notifications by clicking the bell icon. And if you find our news briefs valuable, don't forget to hit the like button. Leave a comment down below telling us just what you think is going on with the state of the world, and share this video with a friend or two so that you can all stay updated together. Thanks for watching, and now let's dive into it. The economy stands at a crossroads, with storm clouds gathering ominously on the horizon. Amidst expectations of further interest rate hikes by the Federal Reserve, renowned investment expert Sherman raises a cautionary flag, warning that a recession may be inevitable. Economic indicators are blinking with urgency, signaling the need for decisive action, yet Sherman fears that policymakers might prove hesitant, ultimately necessitating the most significant rate cut since the pandemic's arrival. As the global central banks grapple with the end of the most aggressive rate tightening cycle in decades, the bond market emerges as a key informant. Sherman, the architect of the Sherman ratio, a bond gauge of interest rate risk, listens intently to its message. Seeking safety amidst uncertainty, he turns to long-maturity government bonds, considering them a haven for investors. Although the current yields on 10-year U.S. Treasuries have dipped slightly from their previous peak, short-dated yields continue to linger at significantly higher levels, a historical indicator of recession. Sherman, however, does not take this warning lightly, convinced that the Fed will be slow to respond and that an emergency meeting might become necessary before a substantial rate cut takes effect. The Sherman ratio echoes his concerns, reflecting a favorable time to buy bonds as it reaches its highest point in 6 years. His portfolio's ratio nearing 1.0 signifies the best outlook in nearly half a decade, indicating that the bond income would be resilient against a significant rise in rates over the following year. Sherman's cautious approach doesn't end with long-term government bonds. He also maintains investments in shorter-dated investment-grade corporate bonds, believing that their solid yields and extended debt terms shield against an immediate recession threat. For Sherman, the timeline for an economic downturn may extend to the next 12 to 18 months, allowing the market to anticipate and adjust accordingly. Employing a barbell structure strategy, his portfolio combines low-risk and higher-risk elements to strike a balance in uncertain times. While some economic indicators, such as the U.S. jobs market, may demonstrate resilience, others are displaying worrisome cracks. The New York Fed's U.S. recession gauge, reaching a 40-year high in June, serves as a stark reminder of the underlying vulnerabilities. Sherman draws attention to the loan market as the likely harbinger of the next default cycle, surpassing high-yield corporate bonds in impact. He predicts that refinancing in the high-yield space might not pick up until later next year, with investment-grade credit facing a similar timeline, but extending even to 2025. Moody's Investors Service further supports these concerns, forecasting an increase in the default rate for speculative-grade companies worldwide. While the current rate stands at 3.8 for the 12 months ending in June, projections suggest it could escalate to 5.1 next year. Under the most pessimistic scenario, default rates may soar to 13.7, surpassing the levels of the 2008-2009 credit crash. In this precarious economic landscape, Sherman's warning rings loud and clear. Watch the rising default rate within the loan market. These floating rate loans have already experienced the full impact of the Fed's rate hikes, setting them apart from the fixed rate market, which has more time before their rates reset. As we stand on the precipice of economic uncertainty, the question persists: Will policymakers act swiftly enough to prevent a severe downturn, or will their hesitation plunge us into an unavoidable recession? Amidst this uncertainty, share your perspective. Do you believe the global economy will overcome the impending challenges, or are we teetering on the edge of an unavoidable crisis? Share your thoughts in the comments section below, and remember to subscribe to the channel to stay up to date on global economic news. See you on the next video, and please like and share if you enjoy our content.